Welcome to Real Estate 360 Live with Ryan Sloper, the trusted name in real estate radio. Now, here's Ryan Sloper.
Welcome, everyone, to another episode of Real Estate 360 Live. I am your host, Ryan Sloper. For those of you not familiar with the podcast, my guest and I will cover every angle of real estate under the sun, from interest rates to the economy to what's happening in Washington. Anything that affects you and your real estate decisions will be covered here. For those of you new to the program, you guys can obviously go to the iTunes store and download and subscribe to the podcast. If you just type in the search bar Real Estate 360, it'll pull up the podcast and you can subscribe to it there. Appreciate if you guys would leave any reviews if you like the show. Love to hear from you. And also, you can also go to the website at realestate360live.com. That's realestate360live.com. On the right-hand side, you can ask a question there, where we have, numerous questions that we've been covering over the last couple of weeks from listeners. And also, you can stream the shows directly from the website if you prefer not to go to the iTunes store. So you can catch it either way. I think, obviously you guys are going to get a lot out of the show. You're going to get a lot of the information that's not actually talked about on the national level, or even in the local level as well. But interest rates are obviously important, so we talk about what's going on behind the scenes that are actually affecting interest rates, the Federal Reserve and Congress, and the implications of what they're doing with monetary policy, fiscal policy, how this can affect things long term. Joining me on our panel, as he does each and every week, is Louis Camerosano, who is a former school teacher, a former attorney, and a former general manager of a major real estate portal. He's been cited in the media as a real estate industry expert. Been cited in Wall Street Journal, Forbes, Smart Money, MSN, Fox Business, and numerous others. Louis, how you doing today?
Doing grand, Ryan. How are you?
I'm doing well. Thanks for coming back on.
Thanks for having me.
We've got, not that much that's really transpired since last week, when we kind of talked extensively about Janet Yellen and what her policies were going to be moving forward. We did talk how, much of the blame lately for the lackluster jobs reports has been placed on the weather. Interestingly enough, we have the ADP jobs report, which came out, the private payroll report came out yesterday. ADP jobs was at 139,000 versus the expected of 160,000. And also, the ADP revised its January jobs from 175,000 to 127,000. All this is really not good news. And from all of a lot of researchers and things that, were saying that, Yellen's hanging her hat on the weather being the reason. And now Wall Street's buying into this because they pretty much shrugged off this news, Louis. They basically said, you know what? We're not worried about that job report. The Fed said that it's the weather, so we're going to go with it's the weather. It's not a major issue. I did read one analyst insight, David Schermeyer, and it was interesting because his thoughts were exactly that, there's no way to cut this other than the employment conditions not good, and that the debate's going to continue whether the weather that we have, if we had a normal winter with the employment situation, would be better. He's saying probably not, though. He said when the January report hit, there was almost universal belief that in the markets that the very weak December job growth would be revised much higher, but it actually never was revised much higher. So, whatever they're thinking, is not coming to fruition down the road, much like we're sitting here talking that Janet Yellen and Wall Street is projecting that things will get better when the sun starts to show its head, right? But ultimately, the numbers, well, they can skew them however they see fit. But reality is that things aren't getting better, and then they'll always have something to blame it on. Now, as a byproduct of all of this, Louis, we've had mortgage interest rates that actually been trading at extreme low levels again, until yesterday when we've got, obviously, the whole crisis going on over in the Ukraine, which is a sideshow and a distraction to more of paying attention to all the problems that we have here in the United States. It's always there's something else going on that allows us to divert the attention to the matters at hand. So just wanted to kind of get your thoughts, Louis, on the jobs reports, ADP jobs report. Obviously, we have jobless claims, which are coming out later this morning. And get your take on jobs report, get your take on where you think the jobless claims are going to come in today, and then also the situation in the Ukraine, and do you agree with the whole, it's just a distraction and just a way for talking heads to divert attention away from the poor economic conditions here.
Okay, so let's talk about the job situation. It's absolutely ludicrous that they're blaming the cold weather for the lack of jobs. We live in the 21st century. People have heating. Roads have not been impassable across the country due to massive snowstorms. The electricity hasn't been down across most of the country. It's just an excuse for making poor projections. And I always mention a poor workman blames his tools and a poor economist blames the weather. You mentioned the ADP report. That was lower than expected. The last two non-farm payroll reports were far lower than expected. I think you had 4,000 jobs and then 120,000 jobs created in December and January. The December was revised up to 75,000. No improvement there whatsoever. The initial jobless claims have come in slightly higher than normal. They're consistently coming in the 330 to 350,000 each and every week. So the weather is not to blame. But as you and I have discussed many times, this is what I call the credibility taper. They are tapering just to gain a little pause that QE isn't forever. And they're saying that they were right to taper because the economy is improving. Now, even though the economy isn't improving, they still have to do this taper, so they throw up the excuse of the weather. And what they always do every year is at the beginning of the year, they say, well, it's starting off slow, and you saw the GDP was revised down in the fourth quarter down to about 2.2 or 2.4%. And they say, well, we expect in the second half of the year, which they say each and every year, the GDP will increase, and they are still expecting a 3% GDP, which would be decent growth for them. Yet Fed President Fisher the other day saying, what is sometimes a headwind can become a very strong tailwind. I believe this is a temporary setback. Once the weather clears up, as you say, it's off to the races. Now, when the weather clears and the economy doesn't improve, well, that's when they can say this was unexpected. We thought we had escape velocity. There'll be some crisis in the Ukraine, and then they'll have to ramp back up the QE. But they will have gained credibility because they have not only been tapering, all of the Fed presidents have been out there saying that they are going to do it, and they are committed to doing it. So there hasn't been this kind of, we need to do QE because the economy is weak. We'll keep our eye on it. No, they've been saying we're going to taper. Minor setback in the weather. We're going to keep going. Then you have Janet Yellen, the chair, saying that she's now going to focus on, as we predicted, unemployment. Now we know that the Fed can't do anything about unemployment, but they spent 5 years bailing out their buddies with QE. It didn't help the employment situation. Now, you can say the unemployment rate went down. We all know that that's not the number to look at. The labor participation rate has also gone down. And as you know, if you have fewer people in the workforce, then you could say you have a lower unemployment rate. But now Janet Yellen's out yesterday saying too many Americans still can't find a job or are forced to work part-time, even though she can't define what a part-time job is. If you recall her Senate testimony. She says, I promise to never forget the individual lives, experiences, and challenges that lie behind the statistics we use to gauge the health of the economy. Okay, so it's 5 years later, and now the Fed is going to focus on unemployment. But guess what? Now you got a Ukraine issue. Well, as you know, the Ukraine issue is fluid, and that can cause any number of things to happen. One of them is, I don't know if you saw the news, that one of the finance advisors to Putin, I don't know what he's called, Tsar, the premier of Russia, the head of Russia, said that if the United States goes ahead and imposes some type of sanctions, which is under consideration in the U.S., that Russians would dump their U.S. Treasuries and advise, I guess, their allies to do the same thing. Now, that, of course, would create a perfect buying opportunity for the Fed, because they're not going to allow a foreign country to dump willy-nilly U.S. Treasuries, which would have an impact on the bond market, sending yields higher and the price lower. They'd just buy those bonds up. And not only would they buy them, they would also, to kind of backstop the market, say, we can't allow this, and they'd buy even more than just the Russians are selling, or whoever else is selling. Because they have an unlimited amount to backstop whoever wants to sell. They can buy them.
Yep.
And I think that's what they're going to do. They'll use the Russian excuse. They'll use any excuse to crank back up the printing press. Maybe unemployment doesn't pick up after the weather clears. Well, we're going to have to do something about it. Well, they can't do anything about it, but they know what they can do. They can print money, and that's what they're going to do. So I think that Yellen is getting her credibility paused. She didn't just want to move into the Fed chairmanship and just keep the printing going. You had to have, in retrospect now, Bernanke stop it on his way out.
Yep.
Yellen continue the stopping. It's a pause because remember, even with the tapering, they could do another $10 billion. They're still printing $55 billion a month, even after 3 tapers, which is still about the size of the prior QEs.
Right.
So this is going to continue.
Yeah, and it's a lot easier for them to, like you say, to maintain some sort of credibility by pushing all their chips in, right, and saying that, it is the weather. We are going to continue this taper. And then obviously once we come into the spring market, if the employment numbers remain as they are, which I see no reason why they wouldn't, that they can say, well, this was so unexpected. It caught us completely off guard. Obviously with, the bad winter that we had no way to see that this was what was going to take place when we got to spring, right?
Right.
As if these numbers hold so much
We'll
weight.
talk about a lag effect.
Exactly.
Just because the weather clears up, it doesn't dry out right away.
Absolutely. Yeah, and that's the interesting
Which
thing
is nonsense.
about.
I mean, that's the kind of stuff they make up.
It is nonsense, and what's actually interesting is that they use these type of lag effects all the time. I mean, just think about in real estate. They'll say, oh, well, right now mortgage applications are way down, right? But the reason why they're way down is because of the weather. They're down because of the weather, and so it's going to take, probably 3 to 6 months for people to get back on track because they're not actually out there searching for homes either because of the weather. Remember, if they weren't going to work, Louis, they're not looking for homes either. But yet we have especially in the D.C. metro area, we have a very low inventory. And see, that's a load of crap because in the D.C. metro area right now, honestly, if something's priced right, if it's turnkey property, it's gone regardless of what the weather is. It's on the market one day and it's gone the next. So, the weather, it can be used all day long as an excuse, but as you said, that's not preventing anybody from actually opening up their business. And very, very few businesses actually do shut down because of these storms. Yeah, they might be a little less productive, but as far as the employment situation, that shouldn't change. People shouldn't really be hiring or firing people because of the weather.
Come on, Canada would have the GDP of Tunisia if they're worried about cold weather.
Oh, absolutely, and I think it honestly is a joke. And
by the way, cold weather adds to the GDP because of the increase in your utilities bill. They actually include that when it should be an expense, but they do include the amount of money spent on electricity and gas to heat your home.
Yeah, which
so it's actually in some respects it's a boon. So if the GDP goes down next time, they'll say we didn't have enough cold weather.
Right. Yeah. I believe there's some talking heads that are talking today too, right? Fisher, Dudley, and Foster, they're all talking today. But it is interesting now to where all of the talking heads are out there, or talking feds rather, are out there basically saying, we're going to stick to this tune of continuing to taper down the line. But as you said, now that we have this fluid situation in Russia, it gives them the ability and another reason why they would have to turn back on the printing press. And
everything they do themselves sets the seed to do more. Right. Now look at the mortgage applications. They're down, and as you mentioned, they're going to blame the weather. But how are prices of real estate going to rise if investors have left the market, mortgage applications are down, unless we have less inventory?
Right.
But that's not a healthy housing market if we're going to have less inventory and less buying, and somehow the price goes up and everyone's going to clap their hands and say, hooray, we have a housing recovery. You've got consumer spending is actually up, which normally would be a good sign, Ryan, because that's a sign, 70% of the GDP is consumer spending. But we also have rising debt levels of consumers, and I suspect also that rising spending in part is due to higher prices, because you had the lowest ISM rating in 4 years, and the unemployment portion of that was even lower. And if that's the sector that's supposed to drive the economy, and that's in its lowest level in 4 years, dating back to the beginning of right as we were coming out of the financial crisis, that's not a good sign.
No.
So if the consumer is heavily indebted, is spending more because it's costing more, the wages are not improving, interest rates eventually will rise, their healthcare costs are higher this year, where's the impetus for this recovery, not just in housing, but in overall economic activity? People making less money, higher costs, and higher cost to buy stuff in terms of interest rates. And then there's nothing to buy when you talk about housing, right? Because there's no inventory. Where's the recovery?
Well, isn't it interesting that consumer spending would be up like that, but yet we'd have this payroll situation which is moving in a complete opposite direction? I mean,
and the wages aren't going up.
Well, no, but how do you explain, and if they did want to hang their hat on the weather, how do they explain the consumer spending? Because people were staying at home.
Oh, right, because they were staying at home? Exactly.
So
no, it makes no sense.
On one end, well, yeah, it makes no sense. And on one hand, it's benefiting them because they can say, oh, look, consumer spending's up. And then on the other hand, they can use that as an excuse. I mean, so they can, twist and turn these statistics and numbers every which way they want. And at the end of the day, that's why it's kind of our job and the job of you and I in this podcast is to break down these things, because if you just read stuff for face value, you're going to think that everything is just peachy, right?
Well, let's go one step further. Look at the President of the United States. Against this backdrop, he presents a budget to increase spending $3.9 trillion because he needs to invest in infrastructure and things that are going to create jobs. He wants to tax the rich and help the middle class. And he's saying that we've lived too long in a time of austerity. Now, I don't understand what austerity. The deficit's increased. Now, they claim the deficit decreased this year. That's only because of one-time items, because they got some money from Freddie Mac or Fannie Mae.
Right.
The point is that not just the deficit is increasing, but the unfunded liabilities are increasing with Medicare, Social Security, and so on, and now Obamacare. So we don't have any money, and yet, to your point, every politician in their minds does not want to face the responsibility of a crisis or no spending on their time. And Obama has said in an interview on late night television, well, the deficit is a problem, not in the short term or in the midterm, but in the long term it'll be a problem when he's long gone. So he needs to present his job as a politician, like any politician, is to give people back stuff, their own stuff, or redistribute stuff from other people to other people to get votes. And to present a budget like that, it highlights the absolute and also the fact that it highlights the absolute lack of any real understanding or concern about the mess we're in. Similarly, the Republicans and the Democrats decided no debt ceiling. We don't have to worry about that either. And then the president says, well, now that the debt ceiling's gone, I got another $4 trillion I want to spend. Now, of course, they're not going to vote for that budget. The point that he even presented it highlights there's a good portion of people who are thinking, oh, okay, well, maybe we'll whittle that down a bit. No one is really thinking the Fed has to stop printing trillions of dollars. The federal government has to stop spending trillions of dollars. It's actually insanity that people think we can get away with this because we have gotten away with it.
Right. Yeah.
And at some point, you don't get away with it, and there's nothing you can do about it.
Well, and Lewis, this is something that I ask you all the time, remember, which is pretty much, okay, when is enough, right? When is it that everybody gets hit upside the head and, with the dose of the reality that's necessary?
It's the straw that breaks the camel's back. I mean, you can pile the stuff on and say, see, we can pile stuff on there. We can keep piling stuff on. Everything is fine. The camel's fine. Look, I'll put something more on there. I'll put this 20-pound sack on there. See, he's still standing. And then,
the funny thing is, too, is that, the president will come out and say something like that, and then the Fed will, at their next meeting, will say something like, well, the president and Congress still need to get their fiscal house in order, right? Or it's going to put more pressure on the economy. Well, really? I mean, it's almost like and that's why I said, there's these backroom meetings, honestly, the president's probably sitting in on or somebody with the Federal Reserve. They're going to have plans that are basically, in direct, I don't know what the word is, opposite of each other, and it makes for banter back and forth to create a supporting position for each of them.
Right. Let's break it down for our listeners. If you have the Federal Reserve buying 70 to 90% of the U.S. Treasury bonds, that means that the Federal Reserve private bank is buying the debt that enables the Congress to do deficit spending at that order of magnitude.
Right.
So when the Fed says that Congress needs to do more, well, what they mean by Congress needs to do more is Congress needs to spend more money. Okay, well, if Congress needs to spend more money, that means they have to borrow more money. Who's going to buy the debt that they have to issue to borrow that money? Well, so far it's been the Fed. So if the Fed is saying Congress do more, and then Congress takes them up on it and says, okay, we'll take Obama's $3 trillion extra budget, we'll borrow more, well, who's going to buy it? And then when there's no buyers because China doesn't want the U.S. Treasuries and Japan can't afford to spend any more money on you have more reserves in Treasuries, then the Fed has to buy them.
Yep. Yeah.
So it's all circular. It's taking money out of one pocket and putting it into the other. The problem is when you put it into the Fed, when the Fed prints up the money, they're a private bank in charge of our money supply, the United States money supply.
Right.
And then they print money to buy U.S. Treasuries. And who else? Who we don't know because there's no audit of the Fed. Where else they spend money? Whether they're sending it to foreign banks, which we found out that they have done before. So what people need to understand about how all this works is they can point fingers at each other, but they're involved in the same game.
Yeah. Well, and going back to real estate, so we've got the Fed that's buying up 70-80% of treasuries and mortgage-backed securities out there, which right now we have an extreme, low interest rate environment. Once again, it's created. Now, isn't it ironic, Louis, that, mortgage applications aren't absolutely shooting through the roof when we
Why wouldn't they be? The chance of a lifetime.
It's
historically low interest rates.
Because they're still stuck in the snow. They're still trying to figure out if it's time to buy or not. You know what I mean?
They can't qualify because they don't have jobs, they don't have the income, or they already own a house and it's underwater.
Yeah, and I would love to see these questions actually asked to the Fed, but whenever anything like this is actually asked, they revert back to something of, well, the data has told us this, and we're going to continue to follow the data. It's never, hey, this is what we think is going on. I mean, I wish they would actually get some courage and just say, hey, look, it's not looking good. So what we're going to have to do is we're going to have to, really pay attention to how bad it's gotten and make some strategic moves. I mean,
Brian, you don't learn courage in college. You don't learn courage in grad school. You don't learn courage by reading economic textbooks.
You're
right. That's the problem. That's who's running the Fed. People who've never had jobs have decided they understand how the world works, even though they never really participated in it. They've only observed it.
Yeah, and so people are asking me each and every day now, they're saying, okay, well, I see that mortgage interest rates are coming back down, so what's going on there? And, weren't you guys talking a while back that rates should start to go back up? And, naturally, yes, they should be. But like I said, this is like pretty much unprecedented times. And
they can't let them because the United States can't afford higher interest rates.
They can't, yeah, exactly.
Nor can the economy.
Yeah, the most elementary thing about
if we're not doing well under the low interest rates, what if they went higher?
Well, the U.S. couldn't pay its debt back, right?
And the economy, which is already not borrowing money because it can't qualify to borrow money to buy houses at these rates, well, if they were higher, you could forget about it.
Right. I mean, and then if Jamie Dimon's already coming out saying basically the mortgage business is the worst business to be in right now.
Right.
Right?
With low interest rates, you think people would be knocking the doors down, they'd be making tons of loans.
Right, which tells you how bad things really are, right? I mean, it really does. I mean, you don't need to look at any of this data. You can tell by the amount of people that are on food stamps, right? On these entitlements, and by as low as mortgage interest rates are, and how many people are actually applying for applications. And actually, of all the people that are applying for applications, how many are actually getting approved for those applications? It's a very small amount.
Just look at the number of home sales, new construction, and existing home sales. They're 3 times lower than they were 7-8 years ago.
Right, and
but housing prices are rising. Yeah, because there's a small amount of inventory. And the few people that can qualify, plus investors, to bid those prices up.
And you know what, Louis? What throws these numbers out of whack is that a lot of these major metropolitan areas, New York, San Francisco, Washington, D.C., right, we
right.
really prop up the numbers for the rest of the country.
Right. It's the law of small numbers. You get these
Yep.
big outsized gains from small portions of the market.
Yeah, and you would think, and what's actually happening is people already aren't qualifying for mortgages these days, but since we have a low inventory, it's actually driving prices up higher. So people that already couldn't afford a $400,000 home, how are they in 6 months to afford a $425,000 house? They're not. They're not, right? And that's what I think that's what you allude to, Lewis, is that there's nothing's really going to change, no matter what. But at some point, when the inventory levels do pick back up, right? We don't know when that's going to take place. That's why I said I think that I'm really going to pay attention this spring and summer what the inventory levels are, and if there is a huge influx of people that are trying to capitalize or get out of that negative equity situation where they can finally just break even and get out of it, if those actually come to the market, or if it stays still in a low inventory environment because people really don't want to make a move because they're scared about their employment situation, right? Or
the only way the inventory will rise, Ryan, is if the demand organically rises because people have more money and more jobs to buy houses. They've artificially manipulated the price of homes higher, which has reduced the inventory. It's kept the problem they have is if they didn't manipulate the prices higher, even fewer homes would be on the market because they'd all be underwater.
Right.
And what they have to do is they should have let the market collapse, but then you would have had massive social unrest because more people would have lost their homes, and then other people would have picked up those homes at lower bargains. And unfortunately, more of the people that would have picked them up would have been investors, and you'd have even a greater amount of investors owning the housing stock. You'd have even more renters, and that's why they did what they did. They were trying to preserve home ownership in the United States, and they managed to keep it above 60% with this little shenanigan that they pulled. But in a free market, what would have happened is people would have foreclosed. They would have gotten out. New people would have bought the homes at lower prices. More responsible owners, investors, and perhaps young people who could now afford the lower price. And it would have been too bad for the people that own the homes, but good news for the people who bought them. Instead, they entrenched the people who made the mistakes, and that's been going on. That's not going to change.
Well, and also let's
they clogged up the housing market.
Right. Well, and let's mention the fact that the FDIC, I'm sure, told the Fed quite clearly that, hey, we need to keep this low interest rate environment in a tight inventory because we can't bail out all these banks if all these foreclosures will continue to happen.
Oh,
right?
Absolutely not.
So they create this environment to basically, once again, bail out the banks.
But what the solution is basically it's a get out of jail free card. It's just print money.
And it's
you can't expect that to go on and have no consequences, Ryan. You can't print $4 trillion and say, okay, we're going to taper, we're going to stop, and everything is fine. If it was only that easy.
Well, it's as easy as they make it seem. It's just like monopoly money. It doesn't really even mean anything to. It means something to you and I, but it doesn't mean anything to them. I think.
Yeah, it means to Ryan the foreign investors, and that's the Achilles heel we got ourselves into by doing this printing shenanigan. Is when 50% of our bonds are owned by foreigners, we're now in a sense, I don't like to use the word held hostage, but in a sense we are. And when you even get these rumblings about China saying we're not going to buy your Treasury bonds anymore, or Russia outright threatening we're going to dump them, we brought that upon ourselves.
So you're thinking that if we get to a situation where the United States is buying up like 70% of its own debt or something like that, that's going to be when things start to turn?
Well, we are buying that, and we're getting away with it because we're buying it, and the other holders, they care, but there's not much they can do about it, that
right.
We're diluting the dollar and the value of their treasuries. The issue is going to come is if I still don't see how the United States, that the Fed can stop buying, forget selling off their treasuries they've already bought. That would be a disaster, $4 trillion hitting the market over a period of time.
Right.
But just stop buying them. The question is, who is going to buy the treasuries that are going to fund the deficits, the ongoing deficits, meaning the ongoing requirements we have to fund the debt that we have and to fund the deficit spending that we do? Even if we drop the deficit, we still have a massive deficit that needs to be funded on an ongoing basis. If the Fed buys 70 to 90% of the newly issued, who's going to buy them? China's already said they're not going to continue to buy them. even if they don't dump their share, who's going to buy them? We talked about mandatory retirement accounts. Voluntarily, people are not going to step up to the plate and buy trillions of dollars worth of U.S. Treasuries. The only way that can happen is if there's some type of mandatory provision where you have to convert a portion of your retirement account or all of it into U.S. Treasuries, because otherwise there is no buyer. We saw recently that the Belgians, it means the EU, bought a lot of Treasuries in the prior month. Maybe EU kind of picks up some of the slack, but we don't really have a buyer along the about the size of the Fed that can buy $50 to $90 billion a month. Now, I think the Treasuries is $40 billion because the other part is mortgage-backed securities. But there is no buyer for $40 billion, not at the current yields that they're offering. There may be at a much higher yield, but the U.S. can't afford to pay that higher yield. So that's where this whole thing is going to break down. And that's why the Fed can't stop buying them. That's why the taper is a bluff. They're still buying them, even though they're tapering, but they have to continue to be there unless they can find an alternative buyer, and there isn't one. And they may have to step up their buying, not just to help the economy, because if Russia dumps theirs, they're going to have to buy those.
Right. Yeah. And they
Where's
know
the answer, Ryan? Who's the buyer? If not
there
the
is
Fed.
no buyer. I think that you brought up the only potential buyer that there is, and that is people using people's retirement accounts, making some sort of mandatory investment into those treasuries, because that's where the bulk of the money is in these retirement accounts, and that's the only place they could potentially pull from. But it's a lot easier for them just to continue to have the Fed print up money and buy them from there, right? That's
of course, because you don't have the whole. I mean, there would be social unrest. A lot of people.
Of course, there would be.
I'm not sure it'd be that big of a deal because I think they can pull it off. Because a lot of people, they would do it after a stock market crash. Let's say Russia dumps their treasuries and the Fed gets behind the eight ball, and the stock market kind of crashes, and they tell people, look, stock market's risky. We can make you whole. We give you a guaranteed rate of return.
We'll guarantee it, right?
Here's the new plan, and then maybe people go for that, and there is no social unrest. They're happy to have it.
Right, because there's no way that the U.S. would ever default, right? So, I mean, I got to feel comfortable taking on an investment that's backed by them.
And the gold standard, they have a printing press.
Right.
They've shown they'll always pay.
Yeah, who needs the currency to be backed by anything, right?
Right.
It doesn't matter.
It's backed by a willingness to print whatever it takes.
Yeah, and then that's where, so I've said many times that I just feel like it's not going to happen on Obama's dime. We're going to continue this, so we've got at least a couple more years of this, Lewis. That's my estimation. Do you think that this can carry on for a couple more years? Obviously, you don't have the golden.
The only way it can carry on is if the foreign countries don't do anything about it. And there's a disincentive for any foreign country to do anything about it because, in a way, the U.S. has gotten into bed with anybody who buys their treasuries because it may be our printing press, but it's their problem because if they decide, I've had enough of this, I'm dumping my treasuries, well, they're shooting themselves in the foot and then in the stomach at the same time. Right. Because that means the value of what they're selling is going to go way down. They're basically going to forfeit their reserves just to teach the United States a lesson. Well, that's the bite your nose to spite your face concept. So that's why they don't do it. I mean, China has $1 trillion of treasuries. Yeah, they can dump them. Well, congratulations. Now you're at $1 trillion.
Right.
That's why they don't do it. Now, what they can do is they can wean themselves off, but that doesn't have the same dramatic effect. But what they can do is as they're weaning themselves off and then don't buy any more, then they make it our problem and not theirs. Because if China and Russia stop buying, slowly sell, and then the United States has no buyer, then they're in trouble.
Yeah,
but still, even in that case, rates go higher and the bond prices drop. Right. They have to get rid of their holdings or get them down to a manageable level and not buy any more. It's a lot easier to do that than it is for the U.S. to stop spending and stop printing.
Well,
they're in the driver's seat.
Yeah, if they stop buying any new treasuries and we keep having the president and Congress throw out plans to increase their spending by, unheard amounts, then that will be an issue that where the Fed has to continue to finance the future of the United States, right?
Right.
I mean, that's
and that creates inflation in the United States, not just because of the increase in the money supply, but then also because if China starts reinvesting their monies not in exporting stuff to the United States, but exporting it elsewhere and consuming their own goods at home, then we don't get cheap goods from China.
Right.
Which, I don't know, there was a book like 3 or 4 years ago called A Year Without China. It was almost impossible for that woman. She tried to buy everything not made in China.
Right.
So it has a very big impact on our economy. I mean, most of the stuff in Walmart is junk. It's not junk. I mean, it's stuff from China.
Yeah.
And that's why it's cheap.
Absolutely.
It's not cheap because the United States had cheap goods in the 40s and 50s because we had the manufacturing here. And we were able to consume what we produce and then export the rest. Now, instead, the way China operates, or did operate, was they produced, didn't consume anything, and shipped it out and made a fortune selling it to us. But now that we don't have that manufacturing capability, and if they cut that off, sending us cheap stuff, or it's too expensive for us to buy it, then our cost of living goes up. And it's not like, okay, well, we'll just buy the refrigerator, the TV, or the other white good, or from the United States manufacturer, because there isn't any.
Right.
That's the real problem we have in the next 3 to 5 years. And then you don't have young people with training in basically anything other than having been to college, because a good portion of them have no job experience in the last 5 years. They've had either part-time jobs beneath their supposed skill set. But you can't count on them to come riding to the rescue right off the bat with innovation. Again, eventually it might be a forced innovation where people have to figure out what we're going to do. But we're in a bad situation. I don't think people realize that. Because interest rates are low and we hear economies improving. We've heard the word recovery more times than I can count.
Right. Well, you would think, I mean, if there ever was going to be a recovery period, it would be now with, stock market rallying, low interest rate environment. The only thing that's missing is that nobody's working. And people are unable to pay their student loans back. And
the highest difference between rich and poor ever in the United States.
Right. We have class warfare, and then we've got the healthcare issue that's creating more pressure on jobs. I mean,
$1 billion to build that website. $1 billion. For the initial was $600 million, and then to fix it was another $400 million.
But since the government was involved, it actually cost them,
And that was Obama's excuse. He says, how it is with government procurement. Like, you're the poster child for why government doesn't work, and you're using government as an excuse why you couldn't get Obamacare done properly.
Right, and cost the taxpayers more money because of it. It is comical. I mean, it's interesting. I don't know where things are headed. Like I said, I don't think that I'm almost convinced now that this low interest rate environment was probably going to carry on for quite some time, just mainly because of the reasons that you and I have just talked about. Because the United States cannot service its debt levels with higher interest rates. They can't. So they're going to do everything in their power to keep them somewhat low. And if like you said, this is just a taper of credibility here to continue down this path. But ultimately, when the numbers don't come in where they need to, they can just reverse course and go back the other way. And
they're insisting the numbers are going to come in. It's just wait till the end of the year. It's like the Brooklyn Dodgers when they lost every year. The Yankees, they kept saying, wait till next year. And next year came around, they got their clocks cleaned again.
Or they'll create some other measure, something else to pay attention. You know what? We don't really care about ADP anymore. They don't really matter. We're going to start looking at something else, right? There's always a way to spin, and as you suggested, these national news outlets, Reuters and all the other ones, they spin it basically to where it's exactly what the Fed wants. It's no coincidence, right?
Oh, yeah. Initial jobless claims every week for the last 9 months have said these lower jobless claims in the low to mid 300s mean an increase in hiring. Well, they don't mean that. And even if they did mean that, or they were some kind of signal, it's proven to be a false signal because hiring hasn't increased.
Right.
And they continue to insist with those types of headlines. And it's only what's funny is you get those headlines from Reuters, AP, New York Times, the main media outlets. If you read the alternative media, they either just report it or they report it and say, well, this wasn't very good.
Right.
They don't put the positive spin on it. That's not a reporter's job, unless it is positive. But there's no correlation between 330,000 people losing their jobs each and every week, and if it goes down from 330 to 328, that somehow that means that people are going to get hired faster, which was one headline, that job growth is improving. Doesn't mean any of that.
Right.
And they have no problem with a straight face blurting out those headlines. And then the Fed, this Richard Fisher, who I had some respect for, he's against QE, calls it monetary cocaine, but yet he's now saying he wants to cut QE, not for the old reasons, because he doesn't like QE because it's money printing and it's monetary cocaine. He says because we don't need it anymore, because the economy is improving and the weather is improving along with it. So even he is not a proper critic anymore. He's basically a cheerleader for the economy. They're all on the same page. The economy is improving. As you say, once they realize, oops, the economy is not improving, even though the weather improved, or we have some kind of spring weather disaster, they're going to have to get back to printing.
Right. Yeah. It was interesting, we're talking about the inventory levels and stuff like that, and when I had a question from a listener, John in Springfield, who had asked me, I'm looking to buy a home in the next, 3 or 4 months, and I'm curious if I should rent out my home if I can't sell it. And I actually feel like the question should be phrased a little bit different. I think that it should be, should I potentially rent out my house instead of selling it, right? Not if I can't sell it. Because I think that this is something that a question you should actually ask yourself before you consider even selling is that should there be a potential for you to rent that property. There's actually some statistics in a report done, I want to say it was done by Redfin, and it was showing that 39% of buyers prefer to rent out their last home rather than sell. And I thought that was really a really high number. And I kind of dug into.
Wait, say that again. 39% of rent.
39% of buyers prefer to rent out their last home.
You mean of someone who's a buyer who's selling a home as well?
Yes, somebody that has a home to potentially sell. 39% of them are preferring to rent out those residences versus actually selling them. So you dive deeper into the information, and one of the lines reads, keeping their old home means that they won't have to risk becoming temporarily homeless like those whose homes sell quickly but can't find a new home before they have to move out. Home buyers in the first quarter were significantly less enthusiastic about buying a home compared with a year ago. The culmination of an ever-worsening inventory situation, rising prices, and mortgage rates in a market that requires a buyer to move fast and compete aggressively has made home buying not for the faint of heart. These factors probably explain in part why 27% of respondents decided to buy a home first before they sold their current one. Now, I do find that this is a very interesting dynamic that's taking place right now, Louis, because since there is such a low inventory of homes that are on the market right now, especially in D.C. metro area, when somebody needs to sell their home and also go buy another home, almost 9 times out of 10, if it's a contingent contract dependent upon the home of somebody's sale of their home, that home seller on the other side is not going to accept their contract because they're probably going to get 5 or 10 other contracts that don't have that contingency. Right? So people are in really interesting situations now where they're kind of saying, well, what's the other way around this? How can I get out of this so I don't have to make this contingent upon the sale of my home? What they're doing is they're turning to renting their home out. Now, do I feel like renting your home out is a bad idea? Actually, it's not. I've told 2 or 3 people in the last couple of days that have bought in the last couple of years and now I'm getting ready to move, and I looked at it and I'm like, okay, well, you can potentially break even on your sale because you haven't really gotten that much equity. By the time you have real estate fees and everything else, you're going to probably break even, if not make a couple thousand. Then you have capital gains because you hadn't even lived there for 2 years in a primary residence, or you have a 3.25% interest rate. I was like, have you even thought about renting this property out?
And you also have the cash flow to pay your new mortgage.
Is exactly where I was going with that. So in a particular instance where you have a 3.25% interest rate, you're only paying $1,400 and you're pulling in $1,650 a month.
Bingo.
For cash flow, guess what? You now have an investment. You now have an asset in a house and somebody else is paying your mortgage. You have a fixed rate at 3.25%, which is unheard of. Now, this isn't renting out is not for everybody. I will caution you. But I think with this low interest rate environment that was created over the last couple of years, and for people that refinanced into lower rates or were able to take advantage of lower rates are now considering moving up to a bigger house or just moving or downsizing or whatever it may be, renting is a good option. Now, the reason why people would rent out their home instead of putting it on the market to sell is they can get some sort of resolution to their home that they're currently living in. They can get it rented out so they know, okay, next month I'm going to have this rented out, and then they can go and find their home and not have to write that contract contingent upon the sale of their home. So these low inventory levels, Lewis, have actually created a problem with the people that are well qualified to buy, right? Because they have to figure out what to do with their current situation.
Well, it also lowers the inventory even more because if they're going to rent them, they're not putting them on the market.
And you know what typically happens with people that have to sell their home and buy another one, what happens after they go through 10 contracts and they keep falling through? They get discouraged, right? Yep. They get discouraged, and it just puts them back out of the game. Well, it looks like we're just not going to buy now. I've heard that 1,000 times. Those exact sentiments, that they just get discouraged because, you know what, in their head, they had it all mapped out. This is what we're going to do. We're going to put our house on the market. We're going to get a contract. We're also going to try to find something at the same time. And for that to time out and to happen perfectly, it's like a perfect storm meeting up. I mean, it's not very
Which is rare. Well, here's another one for you, Ryan. What a lot of people do, which I think is wrong, is they list the home for rent and for sale. Not rent to buy, but, and then you get a confused buyer, whether they're supposed to be buying it to rent it. You get people who are interested in renting it and then find out it's for sale, and then it is for sale. And it puts the real estate agent in a very bad position because if they're saying they're renting and then you show up and they say it's been sold, that's not very good for the client perception.
Right, and you know what the other argument that I get all the time from sellers is, okay, well, how can I make this a smooth transaction? And I said, well, there's nothing in real estate is necessarily going to be smooth. We can try to, put things in place that are going to make it smooth. Well, they look at it, well, okay, well, what happens if I put my house on the market and I do sell it, but then I have to go find a home, and what if there's nothing out there for me to find? I say, well, that's pretty much one of the risks that you do take. Now, what can you do? You can pretty much, I always feel like if you do plan on selling and you don't plan on renting, get your house sold, get it sold. You could potentially do a rent back for probably 60 or 90 days. Now, not all the time, but most of the time you can probably arrange that you could do, especially if
you can stay in your house?
Correct. You can rent back from the new buyers for 60 to 90 days to try to buy yourself a little bit more time. And then if that doesn't work, your next exit strategy is to go and find a rental, a short-term rental, maybe a 3 or 6 month rental. Now, are they difficult to find? Yes. Are you going to pay more? Yes. But I feel like it's smarter to have, one of the issues eliminated, which is selling your house.
If that's your primary concern, yes. And because you want to move into a new house.
Exactly. If you want to move into the new house, then you have to take the potential objections or contingencies away on a new contract that you would write. So by removing that, now it's just as simple as you going and finding another house. Now, it's not
also, if you rent, Ryan, instead, it may be difficult unless you already have the down payment to get the down payment on the new house.
Exactly. And, what happens if, you get a contract on your home and it hasn't sold yet, and then you're going to buy another house, and let's just say that somebody does accept your contract contingent upon the sale of your home, and then the buyer's loan falls through on your home, so now you don't have the money in the down payment for the other home, so then that seller then says, well, you know what, this contract is null and void, and, I mean, this happens all day long, Lewis,
that's not smooth at all.
No, that's not smooth at all, and that's why sellers are very leery of taking contracts contingent upon the sale of somebody else's home.
Especially when there's other buyers that don't have that contingency.
Yeah, so when I saw this, market report that they did showing that 39% of buyers prefer to rent out their last home, it makes complete sense to me because they understand how tight it is out there inventory-wise for them to go and find another house.
They've removed the contingency.
Right. So you go ahead and rent the house out. Now, the only downside to doing that is that if you're going to have to find an alternate source of down payment probably to buy the new house.
Well, probably somebody, like that who is going to rent their home out and able to buy one probably has positive equity in their house and probably has more money. So, again, it's something where people with means obviously can have more options.
I agree. And, I think that, honestly, people that were fortunate enough to be in the situation where they were able to get a 3% or 3.5% mortgage and that they're in a positive cash flow situation where they can potentially rent that house out, and to be honest, be very selective as to who they rent it out to, meaning that they can find renters that have got great credit and be able to, secure 2-3 year leases at a time. I mean, literally, like they could be cash flowing $200-$300 a month plus paying down that asset and have long-term cash flow for themselves. I mean, and when we talk about, investing in real estate, Louis, that is investing in real estate, right? That is actually
unwittingly, but still.
Yeah. You have a secured asset. You have a low fixed rate on that property.
You own that property.
You own it, and somebody else is paying the mortgage for you.
Right. And if it doesn't work out, you can always sell that asset like you could have done in the first place.
Exactly. Yeah. And and that's why I think that, there are many things that come along with renting a home out. I mean, I obviously did do it myself. And the questions that people are asking is, well, what happens if somebody doesn't pay me? What happens if they have pets? What happens? How do I collect rent? All these things. Now, you have the option to rent it out yourself, or hire a broker to get it rented, and then you can just manage it yourself, or you can hire somebody. I mean, typical management fees are probably anywhere from like 10 to 12, 15% if you don't want to manage it. But
will a good manager also handle the eviction process?
Yes. Yeah, a good manager will handle all that. Obviously, the cost goes way up once they start getting involved with that type of stuff. Right. For the most part, it's been, in my experience in helping people with rentals, is that if you do your due diligence on the front end with the potential renters, a lot of the potential problems can be eliminated, meaning that if somebody's got, poor credit, then they better have some ridiculous compensating factors to be able to even consider renting to them. If their compensating factor is for the last 10 years that they've paid a property management company on time their rent, that is a good compensating factor, because it actually says that they actually do care about paying their rent and mortgage, or the rent on time, right? Mm-hmm. That's a very good compensating factor, especially if that rent is comparable to what you're renting your place for. If it was $1,500 where they've been paying for the last 10 years and yours is $1,500, then I would say it's a pretty good likelihood that they're going to continue. Now, the reason why their credit could be bad, and that's why you need to investigate further, could have been that they had some bad luck come up and they had a bunch of medical collections and things like that have pushed their credit down, and they just can't get their head back above water. So I don't always tell people that you just rule people out because of bad credit, but you definitely need to be looking for compensating factors. It's no different than if you go and apply for a mortgage these days. The lender will approve a loan with probably higher debt-to-income ratios if there's compensating factors. The problem is these days, Louis, is people don't have too many compensating factors other than more debt. Right? And that's why a majority of these loans are getting turned down and denied, is that they, the people are making good money, but the debt levels are high, and there's not much you can do. They don't have the capital to pay off the debt, which, to me, is where it's going to be interesting to see where we go from here, because if we have this tight inventory levels and people are already complaining about, hey, well, the home prices are going up, that just means that less people are going to be able to be approved for these loans at the higher price levels. So like you said, that's eventually, when we start to get the downward pressure on prices, Louis, it's going to happen really fast, right? I think it's going to come all at once. And like you said, I think that a lot of this, all these different things, the Fed, the printing, the tight inventory, the stock market, all this stuff at some point is going to come to a boiling point, and it's going to hit the fan.
I can't see how it doesn't.
Well, I mean, obviously,
no one's doing anything about it. It's not like people are working on the project and are making steps to improve the situation. They're ameliorating it. They're not. They're making it worse on purpose.
Right.
By printing and increasing deficits while the economy is not improving.
Yeah, so,
and deluding themselves that it is improving.
Yeah, I think that's the craziest thing is that it's just, you have to be delusional to think that things are improving. Now, when I say things like this, there are companies that are thriving out there. There are entrepreneurs that are building great businesses right now, but that's not the norm, and that's not,
Well, the ones that are getting rewarded are the ones that lose more money. Tesla, Zynga, all of the Facebook, Twitter. Now, those are the companies that have attracted massive amounts of Wall Street capital, venture capital, companies that lose money and don't make money.
Yeah, especially when the money is cheaper, you're basically getting the money for free. It's easy to prop up those other companies. You know what I mean? So
that's where the gains are in the NASDAQ, and it's in the speculative social media stocks. Those are where the biggest gains are. You got Truly and Zillow in the real estate space. They're not making massive profits. And if they're not making profits in this environment, when are they going to make profits? They've been in business 10 years.
Right. Yeah, I mean, you would expect, obviously, when we see the stock market propped up to where it is, that there's companies that are benefiting from this.
They're benefiting from the stock price, but they're not making more money. They're making more revenue, but not more profit.
That's what I'm saying. It's not like they're being necessarily more productive. It's just a byproduct of the market.
Well, it's the other way around. Like with the real companies, the ones that are profitable, they're making more profits, but not more revenues. And then for the companies that are unprofitable, they're making more revenues, but not more profit.
Yep.
Well, that's not healthy.
And
that's not sustainable, because if you're a company that doesn't make money, you only make money because, not because your revenues go up, but because you reduce expenses, or you're a company whose stock price goes up because you make more revenue, not more money, that's very toxic.
Yep. Well, I'd say there's a lot of things that are very toxic right now, right, in our overall economy. All of which, it will come to a head at some point, and we'll keep our eyes on it. We're coming up on the end of the show, Louis. I want to thank you for coming on again, and please give our listeners your blog that they can go and check out your weekly blog post that you do.
Sure. Smallgold.com.
If they want to contact us.
Smallgold.com. A blog post every week, at least one or two, about the economy, real estate, and so on. There's also, you can follow me on Twitter at smallgold.com. There's also a Smallgold YouTube channel and a Smallgold Facebook page. Hope to see you there.
Great. Thanks, Louis. I appreciate it as always.
Thanks, Ryan.
Thank you guys for tuning in. I will be back again next week. In the meantime, subscribe, download our show on iTunes at Real Estate 360. You can also go to the website for any questions you may have at realestate360live.com.